What's going on, guys? It's Ricky here with TechBud Solutions, and Jerome Powell is going to be testifying in front of Congress today, and we will be hosting that live stream, and it should start in just a little bit. So here we go. Alrighty, so should be starting in the next couple of minutes. What's up? What's up? Good morning. Good morning. How are you guys all doing today? We got NASDAQ market pretty much consolidating right now. No true direction. One of the things that we always talk about is, again, anytime that you are unsure of market direction, just make sure you don't put yourself in a position where you can't tolerate worst case scenario, right? We do not know. No one can predict what is about to happen or what he's going to say or not say. I just know that the market, as of right now, is uncertain. And here he goes. All right, well, market's selling off, and he hasn't even started speaking yet. Here it goes. So any moment now, he should be speaking. All right, nice little pop off. Look at that, NASDAQ market dropping. I guess market is just factoring in maybe a more aggressive interest rate hike. Yep, we got NASDAQ with a really nice push down. If I crack 1K, I will join LPP. Okay, sounds like a plan. All right, big push here. Look at that. Here it goes. Real damage. Look at that. Oh my goodness. So again, this is just the market reacting or getting prepared. He hasn't even started speaking yet. But again, we talked about it, right? Do not put yourself in a position in which you cannot tolerate. I do not think that the market, you might be asking, well, what is causing the market to sell off right now? I think the uncertainty is the market will sell off if Jerome Powell comments on being more aggressive with future interest rate hikes. So what we mean by that is, well, if he reports that he's going to be more aggressive and raising rates in the next interest rate hike, which should be March 22nd of 2023, the market will most likely react in a negative way, right? Raising interest rates is never good for the overall economy. It means that it's more expensive to borrow money. Now, if he says that he supports a lower interest rate hike, then that's a little bit different, right? That supports that, well, we don't need to be as aggressive. So therefore, and look at that, super quick. We got SQQQ up 2% on the day, but no, I mean, to my understanding, he has not started speaking yet. Okay, Jerome Powell is late. Surprise, surprise. If you've watched any of his speeches before, we're not too surprised, right? But this is beautiful for if you're part of my LPP team. This is going hand in hand with what I had an opinion on. But again, it's just an opinion. I've made a video yesterday. I talked about why I think that the market is going to sell off based off of recent economic data and based off of the unemployment report, the initial claims report. There's an unemployment report and non-farm payrolls that is about to be released this Friday. Initial claims and continuing claims have all been coming in lower than expected. I think that supports a stronger labor market, and I think that will only support a larger interest rate hike because our economy can take it. Here it goes. I hear.
Hearing will come to order. Welcome, Chair Powell. Thank you for doing your duty and seeming to enjoy it when you come to our committee. Thank you.
Doing your duty. So again, I hope that it earned your thumbs up.
The Fed's actions to combat
Please make sure you
inflation,
subscribe.
whether these actions are actually working, including how those actions affect American jobs and their paychecks. Prices are still too high across many parts of the economy. We know that who feels it the most when the cost of rent and groceries go up? It's not the economic pundits and politicians who lecture us about discipline and stability. It's not the corporate executives who pretend they're making tough choices about prices while reporting record profit increases quarter after quarter and doing more and more stock buybacks. It's the people working hourly jobs to make ends meet. It's seniors on fixed income and Social Security. It's everyone who gets their income from a paycheck each month, not an investment portfolio. It's those same Americans who stand to lose the most if the Fed's actions to curb inflation go too far. No matter what goes wrong in our economy, a global pandemic, a war in Eastern Europe, weather disasters, profits somehow always manage to go up. Workers are left paying the price. As you've noted, Chair Powell, the Fed's tools are only one element in our fight against inflation. It's a complex problem. Interest rates are a single, we know, blunt tool. Raising interest rates can't rebuild our supply chains and fix demand imbalances from the pandemic. Raising interest rates won't end Russia's brutal invasion of Ukraine. Raising interest rates won't prevent avian flu from devastating 1/3 of our egg supply or weather disasters from destroying key crops. And raising interest rates certainly won't stop big corporations from exploiting all of these crises to jack up prices far beyond the increase in their costs. Last year, corporate profits hit a record high. Corporate PR chiefs assure us that these companies just have to raise prices. Their costs are going up. The workers just want to be paid too much. They have no other choice, they tell us. Yet when you look at their profits and their executive salaries and their stock buyback plans, it sure doesn't look like corporations have exhausted every available alternative. It's so brazen, even global bankers called on the Fed to identify this profiteering is one of the biggest drivers of inflation. Paul Donovan, chief economist of global wealth management at UBS, wrote, "The Fed should make clear that raising profit margins are spurring inflation. Companies have passed higher costs on to consumers, but they've also taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures." Think about that. From a chief economist at UBS, I'll say it again, these companies have taken advantage of circumstances to expand profit margins. The broadening of inflation beyond commodity prices is more profit margin expansion than wage cost pressures, unquote. The Fed, understandably, the Fed can't force corporations to change their ways or rewrite the Wall Street business model on its own, but the Fed can talk about it. High interest rates, falling wages, increasing unemployment are all hallmarks of failed policies that end up helping Wall Street, the largest corporations in the country, the wealthiest people in the country. Because let's be clear what we're talking about when people use the economic speak that can cloud this conversation. Cooling the economy means laying off workers. Lowering demand means workers get fewer raises. Of course there are times when the Fed must act. We can't allow inflation to become entrenched. We've seen encouraging trends that isn't happening. And there are other ways we can bring prices down instead of lowering demand. Again, making people poorer, laying people off, denying worker raises. We can speed up and strengthen our supply chains. We can bring critical manufacturing back to the U.S. We can rebuild our infrastructure. It's what we're doing with the CHIPS Act, with the Inflation Reduction Act, with the bipartisan infrastructure bill. For the first time in decades, we're finally recognizing the damage that I and many of my colleagues warned the corporate offshoring would do to our economy. Look at East Palestine, Ohio, a community that Senator Vance and I have visited a number of times recently. America learned about this small town last month when a Norfolk Southern train derailed and spewed hazardous material into this community. East Palestine is more than just a disaster headline. Columbiana County was once the center of American ceramics manufacturing, at one time producing 80% of ceramics of dishware in this country. One county produced 80% of it. When I was there last week, I was talking to the sheriff at the 1820 Candle Company. He was talking about how the last one closed just a few years back. Like so many industries, these jobs moved overseas, and we know why. The same reason Norfolk Southern cuts cost at the expense of safety, eliminating one third of its workforce in the last 10 years. Then you're surprised with these derailments? It's the same reason corporations now keep prices high even as supply chains stabilize. It's the Wall Street business model. Chair Powell knows that, I know that, My Republican colleagues and Democratic colleagues know that. It's a Wall Street business model. Quarter after quarter, corporations are expected to cut costs at any cost. They skimp on safety. They move production overseas to countries where they can pay workers less because of trade deals that they lobbied for. And Wall Street demands they post profit increases, even in the middle of a global pandemic. That's the problem with our economy. And not only will higher interest rates not solve it, if they're overdone, they'll make it worse. We can't risk undermining one of the successes of our current economy. For the first time in decades, workers are finally starting to get a little power in this economy. Unemployment's at a historic low, 3.4%. That's not just a number. That means Americans have more opportunities, more options, even in places that have seen a lot in recent years. It means people have the power to demand raises and retirement security and paid sick days and some control over their schedules. It means more Americans have the dignity that comes with a good job that provides for your family. We must here ensure that all Americans have the opportunity for that dignity of work. It's a critical time. The consequences of missteps could be severe. Mr. Chairman, two more things that affect your job. It's not just monetary policy that threatens American pocketbooks. Some of my colleagues have threatened the nation's full faith and credit by holding the debt ceiling hostage for partisan politics. Instead of paying our bills on time, they're essentially threatening all Americans. The Fifth Circuit's Consumer Financial Protection Bureau ruling could also cause unimaginable instability and chaos for families, for consumers, but also, as the chair knows, for a financial system. The Fifth Circuit is Wall Street's, no doubt about it, the Fifth Circuit is Wall Street's favorite courthouse. It recently ruled the CFPB's independent funding is unconstitutional. If the Supreme Court upholds the Fifth Circuit's ruling, it will not only devastate CFPB, it will threaten
lower lows forming on NASDAQ.
Many other federal agencies, including the Federal Reserve. I look forward to today's hearing, how the Fed will balance its dual mandate and continue to promote an economy where everyone who wants a good job can find one, an economy that works for everyone. Senator Scott. Sorry.
Good morning, Chairman Powell. Sitting here, looking at my prepared remarks, thinking about, there's an opening coming where Vice Chairman Brainer's moving on. I think it's really important for us to make sure that all the information that we need in order to make a good decision on the next nom that we have in a timely fashion. So I would really implore the chair to make sure that happens, that every questionnaire that is asked from the person, we get. Every member of this committee has their questions answered in a timely fashion, and that the staff has their answers in a timely fashion. Listening to Chairman Brown, I thought to myself, fascinating, truly fascinating. I concluded that, well, I know Chairman Brown pretty well. I am sure he is sincere in his rant. But let me just say this. Spending and printing trillions of dollars,
here it goes,
caving to the radical left in this country.
Market trying to recover.
Seeing policies posited and then implemented that led to the worst inflation in 40 years. Seeing our inflation at 9.1%. Seeing American families struggle because of the weight of the government on their shoulders. Seeing the devastation from South Carolina to Ohio. It's unbelievable that the progressives in this country who caused a 9.1% inflation would then turn somewhere besides in the mirror to see the absolute devastation caused by their out-of-control spending is remarkable. Remarkable. To stop the out-of-control inflation caused by the out-of-control spending, the Fed steps in to cool the economy. Well, the definition of cooling the economy is necessary because we've seen the most radical approach to a problem that was in our rearview mirror being used as a Trojan horse to bring in a level of socialism and spending that our nation has not seen in my lifetime. The facts are very simple. When you get to 9.1% inflation in this nation, as a kid who grew up in a single-parent household, mired in poverty, a 40% today, 100% just a year ago increase in the gas prices devastates single mothers around this country. For seniors on fixed income, whose savings are being depleted, with an average cost just last month of a $433 increase because of inflation. For my friends on the other side of the aisle to look any place besides a mirror, I find stunning. The truth is that when your food prices go up over 20%, when your electricity is up over 20%, you have to ask yourself, where in the world are they? They cannot be in this universe. It must be an alternate universe where, in fact, it's okay for us to see prices go through the roof and our economy not stumble, but fall into a ditch. Why are we in the ditch? Because progressives used the pandemic as a way to usher in a form of spending that takes the money out of the pockets of everyday Americans and puts it in the coffers of the government. There is a better way. The better way is to trust the American people. And when you do so, we don't have to have the Fed come in and raise interest rates so high to quell the challenges in our economy so that today versus 18 months ago, the price of the same house for your mortgage payment is twice as high. Why? Because of the runaway spending of our friends on the other side of the aisle.
Testing same support.
I'm sure I do not have time for my opening comments, but I will say without any question, as I look around the country and I ask myself, how devastating is it that today it costs $433 more than it did a year ago? The answer is it is a crisis. When the average family in our country just a couple of years ago didn't have $400 in their savings for an emergency, to have prices go up by this amount, it's devastating. To have a conversation about rents around the country, looking at the inflationary effect and the absolute devastation of a snarling supply chain we haven't seen in my lifetime.
Drop a thumbs up if you just want Jerome Powell to speak already.
Unbelievable. But to get to you, Chairman Powell, one of the comments that you've made that I think is really important in one of the speeches you gave in January, and I apologize for my rant. I just wanted to make sure my rant was consistent with my friend here. It is essential, you said, that we stick to our statutory goals and authorities, and that we resist the temptation to broaden our scope to address other important social issues of the day. Taking on new goals, however worthy, without a clear statutory mandate would undermine the case of our independence. You further noted that, and I quote, without explicit congressional legislation, it would be inappropriate for us to use our monetary policy or supervisory tools to promote a greener economy or to achieve other climate-based goals. We are not and will not be a climate policy maker. Do you still stand by those comments?
I do.
Thank you. Finally, I know we're not in the question. I know, I get it. Finally,
You now have 4 minutes and 12 seconds.
yes, I knew the chairman would dock that from my time, and I appreciate you doing so with a great humor. You're great humor. Finally, several of my Republican colleagues and I sent a letter to you discussing the Vice Chair of Supervision, Michael Barr's plan to conduct a holistic review of capital standards. I look forward to discussing those capital standards during my Q&A, and I will thank you for our recent conversation that we had that helped illuminate some of the necessary challenges that we face as a nation and your answers to it. Thank you, Mr. Chairman.
Thank you. Speaking of illuminating, thank you, Senator Scott.
Yes,
I
thank you for allowing me to use this.
Today we'll hear from Chair of the Federal Reserve, Jerome Powell, on monetary policy
Come on,
and the
homeboy.
state of our economy. And I don't expect Chair Powell to weigh in on the mini debate we just had, but I think we all know that the debt increase was much larger under President Trump and a Republican Senate than it has been since. Chair Powell, thank you for your service and your testimony today.
Chairman Brown, Ranking Member Scott, and other members of the committee, I appreciate the opportunity to present the Federal Reserve's Semiannual Monetary Policy Report. My colleagues and I are acutely aware that high inflation is causing significant hardship, and we're strongly committed to returning inflation to our 2% goal.
He says this speech all the time.
Over the past year, we've taken forceful actions to tighten the stance of monetary policy. We have covered a lot of ground, and the full effects of our tightening so far are yet to be felt. Even so, we have more work to do. Our policy actions are guided by our dual mandate to promote maximum employment and stable prices. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of labor market conditions that benefit all.
Testing, same support.
I'll review the current economic situation before turning to monetary policy. The data from January on employment, consumer spending, manufacturing production, and inflation have partly reversed the softening trends that we'd seen in the data just a month ago.
Yep.
Some of this reversal likely reflects the unseasonably warm weather in January in much of the country. Still, the breadth of the reversal, along with revisions to the previous quarter, suggests that inflationary pressures are running higher than expected at the time of our previous
Market,
FOMC meeting.
not good for the market.
From a broader perspective, inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer run objective of 2%. The 12-month change in total PCE inflation has slowed from its peak of 7% in June to 5.4% in January, as energy prices have declined and supply chain bottlenecks have eased. Over the past 12 months, core PCE inflation, which excludes the volatile food and energy prices, was 4.7%. As supply chain bottlenecks have eased and tighter policy has restrained demand, inflation in the core goods sector has fallen. And while housing services inflation remains too high, the flattening out in rents evident in recently signed leases points to a deceleration in this component of inflation over the year ahead. That said, there is little sign of disinflation thus far in the category of core services excluding housing, a category that accounts for more than half of core consumer expenditures. To restore price stability, we'll need to see lower inflation in this sector, and there will very likely be some softening in the labor market conditions. Although nominal wage gains have slowed somewhat in recent months, they remain above what is consistent with 2% inflation and
Reversal happening on NASDAQ. Watch out for the resistance.
Is good for workers, but only if it's not eroded by inflation. Turning to growth. The U.S. economy has slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Although consumer spending appears to be expanding at a solid pace this quarter, other recent indicators point to subdued growth of spending and production. Activity in the housing sector continues to weaken, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Despite the slowdown in growth, the labor market remains extremely tight. The unemployment rate was 3.4% in January, its lowest level since 1969.
Yep.
Job gains remain very strong in January, while the supply of labor has continued to lag. As of the end of December, there were 1.9 job openings for each unemployed individual, close to the all-time peak recorded last March, while unemployment insurance claims have remained near historical lows. Turning to monetary policy. With inflation well above our longer-run goal of 2%, and with the labor market remaining extremely tight,
Here it goes, breaking
the
above.
FOMC has continued to tighten the stance of monetary policy, raising interest rates by 4.5 percentage points over the past year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we are continuing the process of significantly reducing the size of our balance sheet.
Watch for the rejection
We are seeing
here.
the effects of our policy actions on demand in the most interest-sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee slowed the pace of interest rate increases over its past 2 meetings. We will continue to make our decisions meeting by meeting, taking into account the totality of the incoming data and their implications for the outlook for economic activity and inflation. Although inflation has been moderating in recent months, the process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. As I mentioned, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. If the totality of the data were to indicate that faster tightening is warranted, we'd be prepared to increase the pace of rate hikes. Restoring price stability will likely require that we maintain a restrictive stance of monetary policy for some time.
That's good for the
Our
bears.
overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored.
He does say that all the time.
Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Federal Reserve, we will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Getting rejected by that EMA.
Thank you, Mr. Chair. There are
Watch out for
23 of us
selling
on this
pressure.
committee. Almost everyone will be here today. I ask each of us to stay as close to the 5-minute mark as we can because we have votes at 11:30. So thank you all for your cooperation. Chair Powell, thank you. Job growth is strong as unemployment remains historically low. You might not know that from the opening statements. Many drivers of inflation, corporate greed, rising inequality, supply chain disruptions, Russia's bestiality, if you will, in Ukraine won't get better because of interest rate increases. Every indication is that this post-pandemic economy is different. Should we be worried, Mr. Chair, that the Fed is treating this economic period as it has in the past instead of reacting differently?
This guy needs to stop smoking.
Thank you, Mr. Chairman. So we've been aware since the very beginning and have discussed this publicly on many occasions that there are some differences this time. We, in particular, have not seen the kind of supply side collapse that we saw at the very beginning of the inflation outbreak. Also, the outbreak of a war which had significant effects on commodity prices a year ago. So all that is different. There are also, though, some similarities. There is a mismatch between supply and demand. You can see that in the goods sector still. You saw it in housing prices going up over 40% since before the pandemic, and you see it in the labor market where we have 1.9 job openings for every opening, for every unemployed person. So we're well aware that this particular situation involves a mix of cycles of forces, not all of which our tools can affect, but there is a job here for us to do in better aligning demand with supply.
Okay, understanding you have limited tools to address inflation, and our conversations in the past show my concern about continued rate increases that may not actually address the root cause of inflation. They hurt workers, and many of us contend we can't follow the same old playbook. Next question. Last year, 3 banking regulators issued proposed updates on the Community Reinvestment Act to account for changes in our banking system. My question is, does the Fed remain committed to work with FDIC and OCC to finalize a CRA rule, and when will that rule likely be finalized?
Yes, we do remain committed, and I believe we are in broad agreement with the other 2 agencies on the revisions to the rule. So now we're in the process of writing all that down, and that'll take some time. And then after that, of course, it will come to the Board of Governors for a vote, and that'll involve briefings and discussions. And I can't give you an exact date, but
as quickly as possible.
Yes, but it will be some months.
Thank you. Banks weathered the shock of the COVID-19 shutdowns mostly because of the fiscal response provided by Congress. We now see a spike in loan delinquencies, an increase in overall risk. Banks are again plowing billions, as many other corporate leaders always defended by people on that side of the aisle, into stock buybacks, which makes me concerned if there's a downturn in the economy, banks could end up with too little capital. That's why I'm worried about any potential rollbacks of safeguards or regulations. Can you assure me that the Fed will keep capital requirements strong and exercise more long-term forward thinking than corporate CEOs that seem to be focused on the short term?
I can assure you as to the first part, that we'll keep capital requirements strong.
I didn't expect you to comment on give me an opinion about you're looking more forward than companies that look at the short-term benefits of stock buybacks. Mr. Chair, when you last testified, I asked you about the risk posed by crypto assets, stablecoin, the Fed, and other regulated possibilities. How's the Fed evaluating the risks of crypto-related activities by your supervised institutions?
So this is something we've been quite active in this area, and I'll say that we believe that innovation is very important over time to the economy. We don't want to stifle innovation. We don't want regulation to stifle innovation in a way that just favors incumbents and that kind of thing. But like everyone else, we're watching what's been happening in the crypto space, and what we see is quite a lot of turmoil. We see fraud. We see a lack of transparency. We see run risk. Lots and lots of things like that. And so what we've been doing is making sure that the regulated financial institutions that we supervise and regulate are careful, are taking great care in the ways that they engage with the whole crypto space, and that they give us prior notice. And we've issued, along with the FDIC and the OCC, a number of issuances of notices to that effect.
Thank you, and I will close with this. I've long pushed for the Fed to prioritize workers and for the leaders of the Fed to reflect the diversity of our country. We've made progress, but our work is not done. We have a new opening. Understand it's not your job to appoint the new Fed member. We have a number of upcoming vacancies at the reserve banks. I support Senator Reid from Rhode Island, Senator Menendez from New Jersey, and other colleagues who are pushing for more diverse voices at the Fed. Senator Scott.
Thank you, Chairman. Obviously, the chairman and I both have strong passions about the challenges that we face as a country. The one thing that I do believe that we agree on is the importance of having a strong capital markets as it relates to making sure that Americans have the ability to continue to grow their businesses and to solve their challenges. And frankly, I hope that we get there. Building on the same comment that the chairman had around capital standards is where I'm going to go with my thoughts today. When I think back on these last few years, it's hard not to recognize the extraordinary efforts our financial institutions of all sizes, frankly, undertook to administer a program like the PPP, all while weathering a shutdown of our global economy. I welcome your thoughts, but from my viewpoint, our banking system was resilient. Our financial institutions stepped up and delivered aid to support families and businesses every single day. That's why Vice Chair Barr's broad comments around holistic review of our capital trouble me so much. We should be laser focused on our economy and addressing the needs of everyday Americans trying to forge a new future and helping them open the door to opportunity. As you and I both know, capital and its quality must be continually scrutinized, but increased capital does not necessarily provide an increased benefit. And requiring banks to hold capital that is not risk-based and appropriately tailored to a bank's size, scope, and activities can cause more harm than good. At a time of record inflation, where everyday needs are more expensive, we should not be pursuing actions that are harmful.
Higher highs.
Rather, we should be supporting the engine of our economy, small businesses. While I remain greatly concerned by the Vice Chair's comments, I am hopeful that you will ensure this review is appropriate, keeping the impacts on our banking system front and center. We must promote and further the growth of our economy and thereby our people. Anything less should be unacceptable. To that end, will you commit that any ongoing capital review by the Federal Reserve will follow the law and that any follow-on regulatory proposals will be risk-based and tailored to an institution's activity, size, and complexity, and not a one-size-fits-all.
Yes, I can easily commit to that. We're very strongly committed to tailoring, and I can say that anything we do will reflect tailoring, which is a long-held principle for us and also now a requirement in the law.
Yes, sir. Thank you very much. 2 weeks ago, I sent a letter with Chairman McHenry to Chair Gensler regarding the SEC's climate disclosure rule, urging him to rescind his proposal and reminding him that the SEC is a market regulator, not a climate forecaster. Much like Congress designed the SEC to protect investors, to maintain fair, orderly, and efficient markets, and to facilitate capital formation, and not to advance progressive climate change policies, Congress designed the Federal Reserve to promote price stability and maximum employment, not to play politics. To that end, I find worrying the Fed's announcement of recent actions to consider climate-related scenarios coupled with remarks by the Vice Chair of Supervision as attempts to incorporate broader ESG policies into the financial services system. Banks have and continue to account for weather-related risks in their risk management, but efforts that attempt to predict climate change far into the future fall outside the scope of their authority. Importantly, the level of speculation required in these models should highlight their arbitrary and capricious nature. At a time when our economy is suffering from historically high inflation, I expect our central bank to focus its time and resources on bringing inflation down, not on policy outside of its mandate. I noted in my opening statement a recent speech that you've given about the state of the Fed and how you should resist the temptation to broaden its scope and to address social issues. Do you agree that the Federal Reserve does not have the authority or statutory direction to use its monetary policy or supervisory tools to wade into the ESG or other climate policies?
I do. As you know, there's a tightly focused role that we do have, that I believe that we have, but I would agree with your statement.
Yeah. Mr. Chairman, I have 20 seconds left, but I'm going to defer because of my earlier question to your opening statement.
Thank you, Senator Scott. Senator Menendez is close, but not here yet. So, Senator Rounds. Okay. So, but nice try.
Yes, sir. Whatever you say.
Thank you, Mr. Chairman. Mr. Chairman, first of all, welcome. It's always good to have you in front of our committee. As you know, both core and headline inflation have remained persistently elevated. And over the past 12 months, real average hourly earnings fell by 1.8%, about 4% since President Biden took office. To make ends meet as prices increase, more Americans are leaning on credit cards. At the end of 2022, credit card debt hit a record of $930.6 billion, an 18.5% spike from a year earlier, and an average credit card balance rose to $5,805. Over the past year, the Fed has acted aggressively to tame inflation, and yet we are still seeing price increases. And as we've discussed this several times, but I recognize that it's been an ongoing discussion, but I believe that this further proves that we have long been feeling the effects of a policy-induced inflation resulting from decisions by the Biden administration, primarily cutting off the resources necessary to improve and increase domestic energy production. I continue to be concerned that if you attempt to use the tools that are available at this time for the Fed, then I believe that we're going to have a challenge of not being able to address specifically the challenges brought out when you have a policy that's promoting.
Watch out with the resistance on the moving average
with regard to energy
for all of our bulls,
as opposed to what you're trying to do, which is to bring down the total overall cost. And I just wanted to ask, I guess, and you're going to think this is something that we've heard before, but do you believe that you currently have the monetary policy tools to actually reduce inflation? And I just put it in this perspective. In January of 2021, the CPI was 1.4% when the Biden administration began. In January of 2022, and this is before the Russian invasion of Ukraine, CPI was at 7.5%, 7.5%. Today, March of 2022, CPI is 8.5%. wouldn't it be fair to assess that a lot of the policy or the inflation that we've seen here may very well be due to policy decisions by this administration?
They're just pointing fingers
Senator,
at this point.
not for us to point fingers. Our job is to use our tools. You asked whether we have the tools to get this job done, and we do over time. There are some things that we can't affect, but over time we can achieve 2% inflation, and we will.
In other words, you've got a limited number of tools available to you. And the limited number of tools that you have are designed to impact simply the reduction in prices and so forth. And yet, if there are competing interests out there that are pushing prices higher, you don't have the wherewithal to decide one tool versus another based on whether it's policy induced or whether it is a matter of a shortage in supplies from outside or whether it's war related.
That's right. Our tools essentially work on demand, moderating demand, and so that's what we can do.
So if there were policies in place that actually help to reduce inflation, in other words, and by that I'm just going to look at energy alone just as a good example. If policies were in place that were actually allowing energy prices to come down in the United States, then you would have less of a need to use the very blunt tools that you do have right now with regard to increasing rate increases. Is that a fair statement, sir?
In a sense it is, but I would just say on energy,
I'm not trying to get you to a policy discussion with what the president's doing on his energy policy. I just want to make it clear that you have to respond to what's in front of you, and it doesn't matter where the inflation is coming from or what's driving it up. You're simply trying to bring it back down to that 2% number with the only tools that you've really got.
Yes, but I will say on energy, energy has tended over time to fluctuate up and down, and it's not mainly affected by our tools. So the things we look at are really things that are tightly linked to demand in the U.S. economy. Those we can affect.
And I think just the fact that you've been increasing interest rates, and yet inflation continues to ride up, would suggest, just as you've just indicated, that when you have high energy prices, it's tough to impact that part of it with the monetary policy that you've got available to you.
So we focus on everything, but we also focus on core in particular, which doesn't include energy prices. And what's happened is core inflation has come down, but nowhere near as fast as we might have hoped, and it has a long way to go.
Thank you. One last question. Last June, Vice Chairman of Supervision Michael Barr testified before this committee that he would defend the aggregation method as an alternative approach to the insurance capital standards, the ICS, proposed by the IAIS. As the final compatibility criteria set to come out later this year, can you confirm that you share Vice Chair Barr's views on this AM?
I will confirm that, but I'll have to get back to you on the status of that.
Okay, thank you. Thank you, Mr. Chairman.
Friendly reminder, Jerome Powell is also going to be speaking tomorrow, and the CPI data report is next week on the 14th. I will be live streaming it for free on our YouTube channel, so all we literally ask you to do is drop a thumbs up and subscribe to the channel, and most importantly, turn on your post notifications, because if you don't, YouTube will not notify you when we go live for this inflation report. Probably even more important than these live streams.
Representation in the Federal Reserve's leadership. In the 109-year history of the Federal Reserve, there has never been a single member of the Board of Governors or regional bank president who has the lived experience of being Latino in the United States. And in practice, that means that the voices of nearly 1/5 of our country's people are repeatedly drowned out when the Fed is making critical decisions on economic policy. Decisions that affect whether a Latino family can afford their first home, find a job that pays a living wage, send their children to college, save for a comfortable retirement, or get a loan to expand their business. Right now, the Biden administration has a clear opportunity to make history with its next nomination to the Board of Governors.
Testing support range here.
It has identified a number of highly qualified Latino candidates who have dedicated their careers to the fields of economics, who are committed to the Fed's dual mandate.
Watch for the break below.
The independence of the central bank. The administration has rightly nominated and advocated for a number of diverse candidates with similar qualifications, both at the Fed and elsewhere. But despite having 5 opportunities over the past 2 years to nominate a qualified Latino economist to serve at the Federal Reserve, this administration has repeatedly chosen not to. Representation, or lack thereof, does not happen by accident. It is a choice, and I hope the administration makes the right choice.
I mean, I'm Latino
with this
myself. I have no
nomination.
understanding of what that
Mr.
has
Chairman,
anything to do
Would you
with
say that
what's
it
currently
is,
going on. Ridiculous.
A truism that the United States dollar is the reserve of choice of the world?
Yes, I would.
And that brings us enormous benefits, does it not?
Yes, it does.
Now, 12 years ago, a Republican House brought us to the brink of defaulting on the debt for the first time in history of this country, jeopardizing our credit and the world economy. I'm getting a sense of deja vu because, once again,
Of what?
Republicans are recklessly demanding draconian spending cuts to programs that hardworking U.S. families rely on in exchange for allowing the Treasury Department to pay for spending that Congress, including most of them, have already voted to authorize. If you want to talk about spending cuts, it seems to me that the budget is the time to do that, but not to put the full faith and credit of the United States at risk. Chairman Powell, can you talk about the catastrophic damage a debt default would inflict on the economy?
Look at this Cartier watch.
So I guess I would start,
Ooh,
if I can,
and
by
JP
saying
with
that
his Rolex.
these are really matters between the executive branch and Congress. We do not seek to play a role in these policy issues. But at the end of the day, there's only one solution to this problem, and that is Congress. Whatever else may happen will happen, but Congress really needs to raise the debt ceiling. That's the only way out, in a timely way that allows us to pay all of our bills when and as due. And if we fail to do so, I think that the consequences are hard to estimate, but they could be extraordinarily adverse, and could do longstanding harm.
Well, I think that's a mild statement of what would happen. I understand. I didn't ask you to engage in the congressional executive branch roles. I asked you about the abstract question of what happens if you have a debt default. Isn't even this constant fight putting into question the possibility that the United States will not honor its full faith and credit have consequences within the economy?
In principle, it could. I think markets tend and observers tend to watch this and tend to think that it will work out, and it has in the past worked out. So it needs to work out this time too.
Now, seeing your testimony before the committee,
Testing same previous
is it fair
support.
to say that you'll do whatever is necessary to tame inflation?
We serve a dual mandate, and we will do what we can, everything we can to restore price stability while also serving maximum employment.
And primarily that means additional rate increases, would it not? What other tool do you have?
That's what we have. The balance
Of
sheet,
course.
shrinkage of the balance sheet will continue to. but it's
JP,
principally
tell him.
rate
Of course.
So the question is, when does that part of doing anything necessary to tame inflation, come into conflict with your other mandate of maximum employment?
We have a strong
Not
labor
now,
market.
when we have the lowest unemployment in 54 years,
Yep.
and where we have a labor market that is
Could take the hit.
extremely tight, extremely. So, but in that time could come, but it really isn't now. Where we're very far from our price stability mandate, and in effect, the economy is past most estimates of maximum employment.
Thank you, Mr. Chairman.
Thanks, Senator Menendez.
Watch for the
Senator Kennedy of
reversal.
Louisiana is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Thank you to you and your team for helping to save the economy during the pandemic meltdown. For what
Jesus.
it's worth, I'm generally supportive of the actions of the Fed right now, and I'm not going to ask you today to blame anybody. When Congress spends money, it stimulates the economy, does it not?
Well, it would depend on whether that's funded by tax increases or not. But so, if there's a spending that's not accompanied by taxes, would have a net at the margin stimulative effect.
Well, and when Congress borrows money to spend even more, that stimulates the economy even more, does it not?
At the margin, yeah.
Okay.
Higher highs. Watch out for the bulls.
If Congress reduced the rate of growth in its spending and reduced the rate of growth in its debt accumulation, it would make your job easier in reducing inflation, would it not?
It's reducing their balance sheet.
I don't think fiscal policy right now is a big factor driving inflation at this moment, but it's absolutely essential that we do slow the pace of growth, particularly for the areas of the budget.
All right, let's try to unpack this then. I'm not trying to trick you. You're raising interest rates. You're raising interest rates to slow the economy, are you not?
Yes, to cool the economy off.
And one of the ways you measure your success, other than fluctuation in gross domestic product, is the unemployment rate. Is it not?
Yes, one of the measures.
Okay. So in effect, I'm not being critical. When you're slowing the economy, you're trying to put people out of work. That's your job, is it not?
Not really. We're trying to restore price stability.
No, you're trying to raise
not wages.
You're trying to raise the unemployment rate.
There are a lot of
That means, I know you don't like the phrase, so let me strike it. You're trying to raise the unemployment rate, are you not?
No, we're not trying to raise it. We're trying to realign supply and demand, which could happen through a bunch of channels. Like, for example, just job openings.
All right, let me put it another way, okay? The Economist did a wonderful study. They looked at 10 disinflationary periods in America going all the way back to the 1950s. Disinflation is what you're trying to do. It's a slowing in the rate of inflation. Am I right?
Yes.
In other words, prices don't go down, they just don't go up as fast. Deflation is when prices actually go down. You're trying to achieve disinflation, are you not?
Yes, we are.
Okay. Based on history, in the 10 times that we got inflation down, disinflation since the 1950s, in order to reduce inflation by 2%, unemployment had to go up 3.6%. Now that's history, is it not?
I don't have the numbers in front of me, but yes, the standard has been that there have been recessions and downturns when the Fed has tried to reduce inflation.
Now, right now, the current inflation rate is 6.4%, and the current unemployment rate is 3.4%. Now, if history is right, I'm not asking you to again, blame anybody, but if history is right, unless you get some help, in order to get inflation down from 6.4% to, let's say, 4.4%, and the unemployment rate is going to have to rise to 7% based on history.
That's what the record would say.
Okay, and to get inflation down to 2.2% based on history, an immutable fact, unemployment would have to go to 10.6%. Would it not?
No, I wouldn't.
That's what the record shows. That's what the history shows.
Yeah, I don't think that kind of a number is at all in play here.
I know you're reluctant to admit it, and you don't want to get in the middle of a policy dispute. But I think it's undeniable. It's undeniable that the only way we're going to get this sticky inflation down is to attack it on the monetary side, which you're doing, and on the fiscal side, which means Congress has got to reduce the rate of growth of spending and reduce the rate of growth of debt accumulation. Now, I get that you don't want to get in the middle of that fight. But the more we help
The Bears are back.
on the fiscal side,
Let me
the
see
fewer
it.
people
Drop a
you're
thumbs
gonna
up
have
if
to
you're a
put out of
bear.
work. Isn't that a fact?
Yes, when you raise interest rates, it slows down the
Could
economy
work out that way.
and
Sir?
unemployment goes up.
Yes, sir. Thank you.
Thank you, Senator Kennedy. Senator Reed of Rhode Island is recognized.
Thank you very much, Mr. Chairman. Thank you, Chairman, for being here today. We saw in the wake of COVID the globalized supply chain disrupted significantly, and we're in the process of, in some respects, of rebuilding a supply chain with emphasis on sourcing in the United States. To what extent did that disruptive supply chain contribute to inflation, and to what extent will the new,
Oh my
if you
goodness.
envision it, the new supply chain that is located in the United States and other friendly countries affect inflation?
So the initial outbreak,
These are the people that are running our country and that are making policy for the next generation. Look at this guy.
went way up, and the global supply chain, many goods are
JP
imported. The
is a
global supply
beast.
chain just collapsed. And
Not
that
talking
was the
about
source
it.
of the original inflation. It has now spread over the last 2 years to housing and also to the rest of the service sector. So to your question, we are seeing goods inflation has been coming down for some time now. It's still too high, but it's coming down. Housing services there's in the pipeline. You see the new leases that are being signed, and what that tells you is that in the next 6 to 12 months, we will see that come down. But this big service sector, that's everything else, which is financial services, medical services, travel and leisure, all of those things, that's really where that's the source of the inflation we have now, which had nothing to do with the supply, or not much to do with the supply
Like a
chain.
JP with a clip on his finger.
Now.
And is there anything that you can do that would target that service area without affecting the other areas?
There's not really. Our monetary policy tools are famously powerful but blunt.
A different topic, and that is, as you're probably aware, the
Same support.
Fifth Circuit delivered a ruling in the Community Financial Services Association versus CFPB that the CFPB's funding mechanism is unconstitutional.
What?
Just like the Board of Governors, the CFPB is a bureau of the Federal Reserve. Both the Board of Governors and CFPB rely on the same source of funds and draw on those funds in virtually identical ways. If the Board of Governors funding structure would be found unconstitutional, what would the implications be for the country and monetary
If I was
policy?
JP, I'd be like, what'd you say?
It would be very significant, but I have to say, we have significant responsibilities, but I would be reluctant to comment on a case that's before the Supreme Court.
But it is certainly something that you've had people examine for possible ramifications.
Yes, and the central banks tend to be self-funding because of the way they work, and that's a key factor of our independence.
I'm going to make sure that when next time I host a live stream, I don't open my mouth, okay?
Rate hikes on workers, and you've indicated previously that wages have not been spiraling upwards necessarily, and that inflation expectations are currently stable. But the impact on increased interest rates are usually felt more by low to moderate income people.
Low or high?
Is there any way you can work yourself out of that dilemma?
So where we are right now, of course, is very low unemployment. Wages have been moderating, and they've been doing so without softening in the labor market, without rising unemployment, really, and that's a good thing. So we really don't know. The current situation is a combination of more typical supply and demand issues, but also just things that we haven't seen before.
Update your
the
alerts.
war in Ukraine, like the supply chains that you mentioned.
Right.
So we have many unusual factors, and I don't think anybody knows with confidence how this is going to play out.
Thank you very much, Mr. Chairman. Thank you.
I don't know about you guys, but you know how there's a limit on how old you must be? I feel like there should be a limit on how old you can be to still be in Congress or in any political position that will grant you access to creating policies for the next generation. I don't know about you guys, but I just feel like that's common sense.
Annual inflation rate in 2021 was 7%, and in 2022 it was 6.5%. According to the U.S. Department of Agriculture, the cost of food went up 10% in 2022.
Oh no.
And the real effects of that is moms and dads across this nation that are working to put food on the table for their kids, for their babies, had a harder time doing that. This has devastated hardworking Americans, causing a kitchen table crisis in every corner of our country, as the price of food, energy, and housing have all skyrocketed. In response, the Federal Reserve has raised the Federal Reserve Fund rate more than 4 percentage points. Being far from transient, inflation has remained persistent, high, and well above the Fed's long-run goal of remaining under 2%. In the coming year, what factors and indicators are you paying attention to as you and the Federal Open Market Committee decide on whether to increase rates?
Clear and concise.
So
Easy
I'd
to
say a couple
understand.
things to that. First, we're going to be looking at inflation in the three sectors that I mentioned: the goods sector, the housing sector, and then the broader service sector.
Watch for the lower lows
need
forming. Lower
the
highs.
inflation that's already
lower
underway in
lows.
the goods sector to continue, and that's really important. In the housing sector, we just need the time to pass so that reported inflation comes down, and it's effectively in the pipeline as long as new leases are being signed at relatively small increases. So we'll be watching very, very carefully, though, at the larger service sector, which is 56% of consumer spending, and more than that of what's currently inflation. So that's one thing we'll be watching that very carefully. Also, we raised rates very quickly last year, and we know that monetary policy, tightening policy, has delayed effects. It takes a while for the full effects to be seen in economic activity and inflation.
Next support,
so we're watching carefully to see those effects coming into play. So we're aware that we haven't seen the full effects yet, and we're taking that into account as we think about rate hikes.
So when you're looking at this, obviously not to get into a policy discussion, but if there were an increase of energy production in this country, do you feel like that would help drive down inflation?
Well, I think over time, more energy would mean lower energy prices. Yep. But we are very focused on what we call core inflation, because that is what is driven by really by demand, and our tools are really aimed at demand.
Yeah. Right, understood. But I feel like the cost of energy is not just what you pay at the pump. It ends up affecting every good across this great nation. Additionally, I'd like to ask you about labor participation. So when you look at the unemployment rate, and we've heard my colleagues discuss people having to be displaced in order for us to maybe get to the inflation rate that we would like as a nation, I'd like to focus on the labor participation rate. So right now it's 62.4%. If there were an increase in people coming back into the workforce, would that be a positive factor with regards to driving us down to the 2% rate that you would want to achieve?
I think that it would. I mean, remember those people coming into jobs. Yes. That would be great, because the economy clearly wants more people than are currently working. Of course, those people would then spend more, so it wouldn't be a zero-sum game, but it would be great for the country and great for them if they were to come into the labor force.
Amen. I believe that increasing in capital requirements on financial institutions would have a chilling effect on the economy and the availability of financial services. And last week, I joined many of my colleagues in sending you a letter that expressed concerns that if the Federal Reserve decides to conduct a, quote, holistic review of capital standards, as we heard Senator Scott talk about earlier. So is the Federal Reserve concerned that the impact to the economy of increasing capital requirements on financial institutions at a time when inflation remains persistently high would cause an issue?
So I think it's always a balance. We know that higher capital makes banks safer and sounder. We also know that you will at the margin provide less credit the more capital you have to have. But I think it's never exactly clear that you're at the perfect equilibrium, and it's a fair question, I think, to look at that.
And I know out of respect for the chairman and trying to stay in my time, I will just end by saying I heard what you said. Obviously, as you have said, the Federal Reserve is not and will not be a climate policymaker. I just want to thank you for your public statement on that. I agree with you that there's a difference between policymakers and financial regulators, and certainly look forward to working with you in the future.
Thanks,
I like her. She's my favorite out of everyone else.
Virginia's recognized.
Thank you, Mr. Chairman. Chairman Powell, it's good to see you again. Let me start by saying, depending on who's asking questions, we're either pounding you for how quickly we're going to drive that inflation back to 2%, or pounding you on making sure that we don't push the economy into a recession and drive up unemployment. I got to tell you, and it's these are maybe not the cheap seats, but I actually think you've done a pretty good job in terms of both ratcheting up rates and then starting to tail off a little bit. I think we all were concerned by the January numbers where it popped up a little bit more. I wish, Mr. Chairman, we were actually having this hearing 2 weeks from now, because we're going to have a lot more data later in this week and next week. But I want to net. We've still got ways to go, and the January numbers were concerning. But I do think your tailored approach, we can all second guess, but I think it has been the right approach. I'm going to commend you on that. I want to get two questions in. One of the areas that I am very worried about is commercial debt. I mean, we've got a Bloomberg story here showing, we're going to hit a $6 trillion wall this year on refinancing. Where I'm particularly concerned is the issue around commercial real estate. As we recover from COVID, a lot of things are getting back to normal, but clearly the transformation of where people work is going through a fundamental transition, and I hope people do return more to the office, but lots of folks prefer working elsewhere. That's going to fundamentally change the real estate market on the commercial side, and I do believe we're going to hit potentially a cliff here of a totally unexpected problem in terms of commercial real estate. How are you looking at that issue and recognizing there's lots of bumps coming out of COVID? This one,
I think it's safe to say that you can tell the clear difference between a younger Congress lady versus an old congressman. I mean, it's like night and day different. They can't even properly articulate their question.
You don't see a big spike going on or anything like that. However, of course, there are pockets of concern, and particularly you pointed to the refinancing spike that has to happen, and I've seen those come and go before. Generally, markets can absorb them, maybe at a much higher rate this time, but it's something that we were well aware of and watching carefully. In terms of CRE, I would agree with you. The occupancy of office space in many major cities is just remarkably low, and you wonder how that can be. Now, over time, some of that's going to be made into condominiums and things like that, since we don't seem to have quite enough housing in some places. But the question is, what's the financial stability risk? It's not great for the largest institutions. Don't tend to have a lot of direct exposure to that. Some smaller banks actually do. Medium and small sized banks do. We carefully monitor it. We agree that that's an area that requires a lot of monitoring, and I'd say we're on the case. So,
well, that will morph me into my last question. Something we've talked about, and a lot of my colleagues have talked about with the large institutions. I mean, I do think even some of the biggest critics of Dodd-Frank, I think, would acknowledge our banking system is a heck of a lot stronger and then was able to withstand COVID in a very healthy way.
It sounds like this guy has a lot of commercial real estate.
Evolve is a vast amount of financial institutions move beyond the regulatory perimeter. The fact that we now have way over half of the mortgage origination coming from non-financing institutions, because a lot of the large entities, hedge funds, other funds that may be doing some of this commercial debt or some of the CRE debt. I'd like you to talk generally in the last 40 seconds or so of how you think about this regulatory perimeter. I'm a big believer, and I know some of my colleagues are, that that we ought to look less at charter and look at same risk, same regulation, maybe as a guiding principle. And I know Senator Warren's been working on some work. I've been working on some work around crypto around that area. But there's a vast amount of activity that's taking place outside the regulatory perimeter. How should we be thinking about that, and how do we make sure that doesn't create the kind of crisis sneak up that happened in 2008 on the non-regulated side of the house?
I think you articulated the principle very well. It's same activity, same regulation, and that covers crypto and all kinds of other activities. People are going to assume when they deal with something that looks like a money market fund that it has the same regulation as a money market fund or a bank deposit. And so stable coins need some attention in that respect. I just think that's the basic principle. And you're right, so much of intermediation has moved away from the regulated banks really for a long period of time. And we got to keep an eye on that.
Thank you, Chair Powell. We can keep looking at it. I hope it's
Thank you, Senator Hagerty of Tennessee.
Thank you, Chairman Brown. And, thank you very much, Ranking Member Scott, for holding this hearing. Chairman, it's great to see you again here. I appreciate your presence, and I appreciate the opportunity to talk with you about an item that I'm particularly concerned about, and that's the holistic review that Senator Britt just brought up that Vice Chair Bauer is conducting right now. It's generating a sense that higher capital requirements are on the horizon for us. And as I think about that in the context of what we've weathered, you think about the situation in 2020, it was an acute, real-life stress test, if you will. And I think that our financial system navigated that admirably.
Ooh.
In the past, Chair Powell, you told this committee that our financial system has proven resilient.
Justin, what is that?
Through 2020, and that the capital levels at that point in time, and I would note that those capital levels are at multi-decade highs, are in aggregate adequate. And I just wanted to follow up on those prior statements and see if you still feel that way.
So I guess I would say it to you this way. In our system, we have a vice chair for supervision who has statutory responsibilities. And when a new vice chair for supervision comes in, generally they're going to want to take a fresh look. That's what the former Vice Chair Quarles did, and that's Dan Chiarullo kind of had the job on an informal basis, and that's what he did. So it's only natural that someone would come in and take a fresh look, and I think that's part of the process. The role of that person is to make recommendations on regulation supervision to the full board. The role of the board is to consider those when made, and this just comes under that heading.
Well, as the review is underway, and I appreciate that context, one aspect of it seems to us as an apparent willingness to undo the tailoring requirements that were enacted as part of S2155. And I understand that nothing has been finalized regarding the regulations. It's a concerning prospect if that's the case. The Fed's General Counsel just yesterday alluded to undoing 2155 by, quote, pushing down the Basel requirements on banks that were intentionally given relief in that bill. So I want to be perfectly clear that the banking regulators themselves can't just simply ignore or selectively enforce the laws. And again, I realize that the details of the study haven't been finalized and made public, but if the proposal put forth by Vice Chair Barr is either unduly aggressive or appears to contradict the spirit of S2155, will you vote for it?
I can't answer that in the abstract, of course, but I would say we're, as an institution, very strongly committed to tailoring, and anything we do is going to reflect, tailoring of institutions according to their risk, and I mean that's a principle that we'll stick with.
I think it's quite important, again, given the legislative intent here and the concerns that we maintain that in the face of what General Counsel said just yesterday. I appreciate your perspective in terms of keeping that in place. I'd like to come with my next question, Chairman Powell, with starting the question by underscoring the importance of the independence of the Fed's monetary policy. Right now, the economic picture is about as uncertain as I can remember. We've had large companies in the private sector who are in the midst of planning layoffs and forecasting serious economic weakness in the quarters to come. Yet, on the other hand, the current economic data seems to be robust. Inflation showed some signs of softening in the past several releases. So I just hope, Chair Powell, that you could briefly tell us how you synthesize these seemingly contradictory data.
So just quickly, at the end of last year, we saw a couple of very promising, modest inflationary readings in November and December. But earlier this year, some of that improvement was revised away. In addition, we got a very strong reading on inflation in January, also very strong jobs reading, also very strong retail sales. And so, as I pointed out in my testimony, we're looking at a reversal, really, of what we thought we were seeing, to some extent, a partial reversal. It's still true. It's still the case that we're seeing progress on inflation. We're seeing goods inflation has come down significantly. There's improvement in housing inflation in the pipeline. There's not a lot of improvement yet to be seen in the largest sector, which is non-housing services. So core inflation is running at 4.7% on a 12-month basis. I think nothing about the data suggests to me that we've tightened too much. Indeed, it suggests that we still have work to do.
And then in that context, thinking about where the tightening goes and when it might, where and when it might happen, where do you see the terminal Fed funds rate landing in this cycle?
So we last wrote down our assessments, individual assessments of that in December, and I think the median range was, basically people were clustered between 5 and 5.5. We're going to write down those again as part of them. We do it 4 times a year. We'll do it around the March meeting, which is on the 21st and 22nd of March. And as I indicated in my testimony, I think that the data we've seen so far, and we still have other data to see, we still have significant data to see before the meeting, suggests that the ultimate rate that we write down may well be higher than what we wrote down in December.
Got it. Thank you, Mr. Chairman.
Thank you.
Thank you.
What data is he talking about? We have non-farm payrolls,
Thank you, Mr.
unemployment
Chairman.
rate.
So the Fed has
has raised
Friday.
interest rates 8 times over the last year in what has been the most extreme rate hike cycle in 40 years. The Fed's goal is to slow inflation, and your tool, raising interest rates, is designed to slow the economy and throw people out of work. So far, you haven't tipped the economy into recession, but you haven't brought inflation entirely under control either. And maybe the reason for that is that other things are also keeping prices high, things you can't fix with high interest rates, things like price gouging and supply chain kinks and a war in Ukraine. But you are determined to continue to raise interest rates, so I want to take a look at where you're headed. In December, the Fed released its projections on the state of the economy under your monetary policy plan. According to the Fed's own report, if you continue raising interest rates as you plan, unemployment will be 4.6% by the end of the year, more than a full point higher than it is today. Chair Powell, if you hit your projections, do you know how many people who are currently working, going about their lives, will lose their jobs?
I don't have that number in front of me. I will say it's not an intended consequence.
But it is, and it's in your report, and that would be about 2 million people who would lose their jobs. People who are working right now, making their mortgages. So Chair Powell, if you could speak directly to the 2 million hardworking people who have decent jobs today, who you're planning to get fired over the next year, what would you say to them? How would you explain your view that they need to lose their jobs?
I would explain to people more broadly that inflation is extremely high and it's hurting the working people of this country badly. All of them, not just 2 million of them, but all of them are suffering under high inflation, and we are taking the only measures we have to bring inflation down.
And putting 2 million people out of work is just part of the cost, and they just have to bear it?
Well, will working people be better off if we just walk away from our jobs and inflation remains 5-6%?
Let me ask you about what happens
For the
if you
greater
do this.
good.
Since the end of World War II, there have been 12 times in which the unemployment rate has increased by 1 percentage point within 1 year, exactly what you're aiming to do right now. How many of those times did the U.S. economy avoid falling into a recession?
You know, it's not as black and white as very
Just
very
looking at
infrequent.
the numbers, it actually is pretty black
Alan
and white.
Blender's written a book on this, and
There have been 12 times that we've
How are you
seen
gonna ask him a
1
question
point
and not let him
increase in the unemployment rate in a year. That's exactly what your Fed report has put out as the projection and the plan based on how you're going to keep raising these interest rates. How many times did the economy fail to fall into a recession after doing that? Out of 12 times.
I think the number is 0.
I think the number is 0. That's exactly right. So then the question becomes, we've got 2 million people out of work. Can you stop it at 2 million people? History suggests that the Fed has a terrible track record of containing modest increases in the unemployment rate. Once the economy starts shedding jobs, it's kind of like a runaway train. It is really hard to stop. In fact, in 11 out of the 12 times that the unemployment rate increased by a full percentage point within 1 year, unemployment went on to rise another full percentage point on top of that. If that's what happens this time, we'd be looking at least 3.5 million people who would lose their jobs. So, Chair Powell, if you reach your goal and 2 million people get laid off by the end of this year, and then, just like in 11 out of 12 times that unemployment has risen by a point in a single year, it keeps on rising. And then we've got 2.5 million people out of work. We've got 3 million people who get laid off. We've got 3.5 million people who get laid off. What's your plan?
Well, right now the unemployment rate is 3.4%, which is the lowest in 54 years. And we actually don't think that we need to see a sharp or enormous increase in unemployment to get inflation under control.
I'm looking at your projections. Do you call laying off 2 million people this year not a sharp increase? in
I would say
unemployment?
4.5%.
Explain that to the 2 million families who are going to be out of work.
We're not targeting any of that, but I would say even 4.5% unemployment is well better than most of the time for the last 75 years.
In other
Exactly.
words, you don't have a plan to stop a runaway train if it occurs. Chair Powell, you are gambling with people's lives, and there's a pile of data showing the price gouging and supply chain kinks and the war in Ukraine are driving up prices. You cling to the idea that there's only one solution: lay off millions of workers. We need a Fed that will fight for families, and if you're not going to lead that charge, we need someone at the Fed who will.
Senator Vance of Ohio.
Thank you, Mr. Chairman. Chairman Powell, thanks so much for being here. I have a question that's
Pull the cord.
slightly far afield, but how often you get to talk to the Federal Reserve Chairman, so I might as well ask it. So to give some context here, my family comes from Appalachia. Particularly my grandparents grew up in southeastern Kentucky, coal country, and then moved to southern Ohio, where I now have the honor of representing all of Ohio. And one of the things that you hear a lot when you study the regional history of Appalachia is it's often described as possessing a resource curse, right? So there's a lot of coal in central Appalachia that enables a certain amount of consumption. Obviously, consumption is good. People need food and medicine and other things. But there's also a pretty good argument that for a host of reasons, it causes malinvestment in the region. And consequently, you have lower productivity growth, lower innovation, and an economy that's much less diversified and much less dynamic. I'm wondering, when I hear about the history, when I think about and read about the history of Appalachia and the resource curse, I'm struck by by the idea that you could make a similar argument about the reserve currency status of the United States dollar. Americans have enjoyed one of the greatest privileges of the international economy for the last nearly 8 decades, a strong dollar that acts, of course, as the world's reserve currency. You know that better than I do. Now, this has obviously been great for American purchasing power. We enjoy cheaper imports. Americans, when they travel abroad, benefit from lower costs. But it does come at a cost to American producers. I think in some ways you can argue that the reserve currency status is a massive subsidy to American consumers, but a massive tax on American producers. Now, I know the strong dollar is sort of a sacred cow of the Washington consensus, but when I survey the American economy and I see our mass consumption of mostly useless imports on the one hand and our hollowed out industrial base on the other hand, I wonder if the reserve currency status also has some downsides and not just some upsides as well. And let me just put a final point on this, and I'd love to get your thoughts on that, Chairman Powell. We're, of course, now the main supporter of a massive land war in Europe between the Russians and the Ukrainians. I read recently, and I'm not going to comment on how perfect or precise these estimates are, but I read recently that the United States is trying to ramp up production from 14,000 artillery shells to 20,000 artillery shells. That's per month, while the Russians are firing 20,000 artillery shells in Ukraine per day. And when I look at the American economy, we have a lot of financial engineers and a lot of diversity consultants. We don't have a lot of people making things. And I worry that the reserve currency status and the lack of control we have over our currency is perhaps driving that. I'd love to get your feedback on that. What are the upsides and downsides of the reserve currency?
That's a big question to try to answer.
You have 2 minutes, Chairman Powell, so plenty of time.
I can't even get started on that. So we are the world's reserve currency, of course, and that's because of our democratic institutions. It's because of our control over inflation over many, many, many years. The world trusts the rule of law in the United States, and those are the things. So once you're the world's reserve currency, it's used in all over the world in transactions, and it's the place where people want to be in times of stress, is in dollar-denominated assets. Now, so of course we benefit by being able to pay for our goods all over the world, pay for everything anywhere in the world mostly with dollars. That's an advantage. There's some economic theory around that it also has burdens of various kind, but I can't call it all back to mind. But the other thing is, it's a very stable equilibrium, but it's not a perfect one. It's not a permanent one, rather. So there isn't any obvious candidate to replace the United States right now, where you can have free flow of capital in and out of the country, where you can really trust the rule of law and democratic institutions, and keeping keeping price stability, which you can here.
Do you think it gives us less control over our own currency, the fact that it's become the world's reserve currency?
Control over our currency. I'm not sure. So essentially what we try to control is price stability. And no, it doesn't make it harder for us to keep inflation under control. The United States has a smaller external sector than most large economies, where it's only about 15%. So mainly what affects inflation in the United States is domestic supply and demand.
Do you think it makes it harder for us to to fight back against currency manipulation, to control the export and import flows in a way that stabilizes our own manufacturing sector?
Well, I mean, what's important there is really the level of the dollar, and when the dollar is stronger, obviously our wares are more expensive abroad and that kind of thing. But we don't have an opinion on matters of the level of the dollar really matters for the Treasury Department and the elected government, not for the Fed.
Thank you, Chairman Powell.
Thank you, Senator Vance. Senator Van Hollen of Maryland's recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here and for your service. I know the Fed is experiencing lots of challenges these days. I've got a couple questions that are just, I think, basic yes or no's, and then some longer questions. Would you agree that changes in the size of corporate profits can be one of the factors that affects the inflation rate?
Oh my God.
Yes.
Right. Now, recently we saw that the Employment Cost Index, which, as you know, measures the growth of wages and benefit costs, grew at roughly 4% on an annualized basis in the fourth quarter of 2022. Is that right?
That's my recollection, yes.
So if corporate profits were to decline from the extremely high levels that we saw recently, would it be possible to sustain the 4% growth rate in the Employment Cost Index for an extended period of time, even as we get inflation down to the target of 2%?
Depends on what you mean by extended period of time. So you would not, without a very, very large increase in productivity, which would be great, but that we don't expect, you wouldn't be able to sustain 4% wage inflation over the longer term. Over the shorter term, though, yes.
So over the shorter term, that would not be a justification in and of itself for raising rates. Is that right, in the short term?
Well, I think wages affect prices and prices affect wages. I think we do think that some softening in labor market conditions will be
test and support
will happen as we try to get inflation under control, and will need to happen.
Right, but that's more a prediction about your efforts to fight inflation. Are you saying that simply looking at the current 4% growth rate in the short term is an excuse for jacking up interest rates?
I think what I would say is that the overall, all the data we look at in the labor market, including not just that measure of wages, but others, also unemployment, also participation, also job openings and quits and things like that. All of that, you put that into the picture, and I think you see a labor market that is extremely tight and is probably contributing to inflation. I've never said it was the main cause.
Right. I think the larger point here, based on your response to that first question about growth in profits, is corporations have a decision as to whether or not they're going to pocket more for profit, which they can, or provide higher wages to their employees. And if you actually lowered your profit margins, you could sustain a higher wage increase without violating the 2% inflation. Isn't that right?
Yes. I mean, when I hear profit margins, what we're seeing in the economy is pretty much about shortages and supply chain blockages. And when there's not enough of a product, what happens, and there's a lot of demand, what you see is prices going up. As the supply chains get fixed and shortages are alleviated, you will see inflation coming down. You'll see margins coming down, and that will certainly help with inflation.
Right, but profits are the margin, right? They're going up beyond what they were before. That means that even with the increase of costs because of supply chains, they're making more profits. Which again, that they can do that. But my point is that as a contributor to inflation, as you indicated in response to the first question, let me ask you about the tight labor market because one of the issues in the tight labor market is parents with kids, including a lot of moms who would like to go back into the market, but are not able to do so because of lack of affordable childcare. The other issue is immigration, and I know that you've gotten some recent data on how some immigration figures actually have softened a little bit the tightness in the labor market. Can you just talk broadly about those two factors, affordable childcare and immigration, more legal immigration, and how they could affect labor force participation and therefore also reduce inflation pressures?
So on the first, we don't make recommendations or evaluate fiscal policy, but I will say there's research that shows that it helps keep women in the workforce when there's childcare available, which is, I think, kind of self-evident. The second was
impact of immigration.
Yeah. So what I talked about with you is actually as part of the January Bureau of Labor Statistics report, which comes the employment report for January, which comes out in early February. There is a section in there about more people. The Census Department has increased its estimate of the workforce by something like 870,000, and a significant part of that has been immigration. And that has moved up participation by a little bit, but it may be part of why we're hearing. It may be part of why we're hearing from in the labor market that the really intense labor shortage pressures that we were hearing about in 2021 and 22 may be alleviating. So that would contribute to that. Clearly, more people. Clearly, the economy is calling for more people with essentially two job openings for every unemployed person, and this can be a source of those people.
Right, and that would reduce the tightness of the labor market and reduce pressures on inflation, right?
May already be doing so.
Thank you.
Senator Kramer of North Dakota is recognized.
Thank you, Mr. Chairman. Thank you, Chairman Powell, for being here. And I can't resist responding to a few things that my friends on the left have said. For example, in his opening statement, Chairman Brown had a long list of things that raising interest rates won't do. Raising interest rates won't fill in the blank. I'm going to fill in the blank with a couple things. How about raising interest rates won't stop Senate Democrats and President Biden from overtaxing, overspending, overborrowing, overregulating? Chairman Brown said we should rebuild our supply chain by curbing offshoring, corporate offshoring. I agree. He talked a lot about corporate greed contributing to inflation. Okay. But how about regulatory greed contributing to corporate greed? How do you expect corporations to reinvest money if you overregulate their ability to invest that money right here in the United States of America? You want to onshore some things? How about energy policy? How about instead of looking to Venezuela or Iran for oil supply or Russia, or rather than looking to China for electric vehicles and chips and solar panels, how about we have a strategy that onshores those things by reducing regulation, reducing taxes, and letting those corporations reinvest their profits rather than stock buybacks or dividends. This idea that somehow the Federal Reserve is supposed to keep inflation in check while half of the government works against it is mind-boggling. Now, I know, Mr. Chairman, you don't like to comment on policy. You and I have been around and around about this. You were anxious to advise us to spend lots of money during the pandemic. I don't think a lot of people blame you for that. You wouldn't respond to efforts by the Biden administration after we were in a robust recovery from not spending so much money. Okay, I can appreciate the change. But now we're in this debate between Republicans and Democrats, between particularly the House Speaker and the President, on how to raise the debt ceiling. And you've made some pretty strong comments about raising the debt ceiling, absent from structural reforms that would actually help us get back to a reasonable growth. So I warn you again, if you're going to make political comments, if you're going to advise us on policy, be consistent with it. Now, I want to get back to the greening of the Federal Reserve and these I call them stress tests. You can call them whatever we call them. But I'm concerned that now the Federal Reserve is starting down this path. Maybe it's slightly at first about climate stress testing. I just want to ask you this. If we're going to go down that path, if the Federal Reserve is now going to become part of the Federal Climate Police Force, are we going to consider the ramifications of having entire communities and economies, factories and manufacturers, whatever, energy entities, large server farms, leaving them susceptible to a very unreliable, very expensive energy source. Is that part of the stress test?
No, those are considerations for elected people, not for us. We have a narrow role to play here, but it's a real role, and I can talk about that if you'd like.
Well, I would like you to, because again, if we're gonna start doing stress tests for the 6 largest financial institutions related to climate, which really is more weather than climate, then are we gonna consider the effects of an unreliable energy source at several locations throughout our country?
So our only focus is on the safety and soundness of these institutions, and do they understand and can they manage all of the risks that they run in their business model. That's our only goal. We're not looking to be climate policymakers. Climate policy is clearly going to have effects on regions, on companies, on individuals, on countries, disparate effects, and that is not for unelected people like us who have a narrow mandate. But I think it does touch climate, and you're right to be concerned that we find ourselves on a slippery slope. But honestly, I think
watch for a break of
climate
support.
scenarios are something that the banks are already doing and themselves, and the climate guidance is something that they're looking for. They want to know how we're thinking about this, but we will try really hard not to get on a slippery slope and find ourselves becoming climate policymakers. It's just not appropriate for an independent agency.
Okay, and I completely agree, and I hope you stick to that, and I think, yep.
All right, guys, I'm going to close out the live stream here. So Jerome Powell hasn't necessarily said anything that is out of left field. I feel like the market is pretty much just digesting or getting ready in case he does say something. Once this live stream closes, just know that the market direction can completely change, right? We did sell off a little bit. Market direction can begin to recover. So all I'm saying is if you're shorting the market, I'm shorting the market. As you saw, I was covering part of my position in SQQQ, and the reason why is because once this speech ends, I could see the chance of market beginning to recover because nothing horrible was said. So I'm just making you aware because I want to make sure you keep some of the profits, especially if you're shorting the market. If you're a bull, right, and the market begins to recover, then again, just watch your position size and wait for that proper confirmation. I really do appreciate the time that you guys have taken to watch this live stream. I will be live streaming this again tomorrow. For those that are unaware, Jerome Powell is going to be testifying in front of Congress again tomorrow, 30 minutes after the market opens, and I will be live streaming it for free on this YouTube channel for the people that are subscribed. So all we ask you to do is get this video to over 2,500 likes. Make sure you subscribe to the channel, and again, make sure you turn on your post notifications so you are alerted when it is that I go live. I host these live streams for free all the time, and again, would love to be of value for you. One of the things that I do want to remind you is, again, we are running our biggest giveaway. I know a lot of you guys have been asking for our discount. It's $150 off. I do trade live every single morning. It's a one-time payment, lifetime access, and right now we're running our 2019 Nissan GTR giveaway or $50,000 cash. Yes, you are hearing that correct. We're giving away a 2019 Nissan GTR or $50,000 cash, and a way to enter is by signing up for Learn Plan Profit 2.0 right now. We'll earn you 5,000 entries for you to for a chance to win this GTR or $50,000 cash. So again, if you've been waiting to join, now again you can kill two birds with one stone. Not only do you get our biggest discount, not only do you get to join our LPP team and watch me trade live every day, but you also get entered 5,000 times. If you want to enter another way, right? The only other way to enter is by heading on over to shoptechbuds.com or the fourth link in the description down below. And for every $1 that you spend, it equals 5 automatic entries. So again, I mean, you can buy a crew neck, that's 300 entries, a t-shirt, that's 150 entries. Everything is provided for you on shoptechbuds.com or the fourth link down below. So again, if you want to join LPP, biggest discount, second link, or TechBuds Apparel, that's going to be the fourth link down below. If you have any questions, feel free to message me either via Instagram or Discord, and that's the first or third link in the description down below. Other than that, I do appreciate you guys' time. I'll see you in tomorrow's live stream. But most importantly, I hope that you guys did well today with the market selling off. We talked about it. We had an expectation, and finally today it went according to plan. Now make sure you hold yourself accountable, you stay disciplined, and you lock in those profits once and if there begins to be a change of direction. Remember, there is no time for needing or trying to be a perfect trader. You will never be a perfect trader. I will never be a perfect trader. That is okay. as long as you begin to show signs of progress. And that's what always is most important. So I appreciate your time. Hope that earned a thumbs up. Please consider subscribing. Again, second or fourth link in the description down below are how you can join the giveaway. And then I'm using the Webull trading application. And if you want to use it, it's the fifth link in the description down below. Like always, let's make sure that we end the year on a green note. Take it easy, team.